Hey everyone, welcome back to Corporate Decoder, the place where we dissect those dense corporate filings so you don't have to. Today we're diving into a report that's a bit like a cancelled wedding, only instead of cold feet, it's cold hard cash that didn't show up. So here's the story in a nutshell. Newbury Street Acquisition Corporation, a special purpose acquisition company also known as a SPAC, had a deal to merge with Infinite Reality Inc. Think of a SPAC as a blank check company that exists only to acquire another company. This merger was supposed to bring Infinite Reality, a company, into the public markets. But alas, the deal fell apart and there was supposed to be a $7 million breakup fee. However, that money never arrived. Let's rewind a bit and talk about the players here. Newbury Street Acquisition Corporation, the SPAC, was looking to take a private company public. Infinite Reality, the target company, was the company they had their eyes on. The goal was to combine the two companies so Infinite Reality could be listed on the stock exchange without going through the traditional initial public offering process. The deal was initially announced in December of 2022. The initial agreement was laid out in something called the merger agreement, but these agreements are rarely set in stone. There were a total of 3 amendments or changes to the merger agreement showing the changing nature of the agreement. These amendments changed details of the deal along the way. The first amendment came in May of 2023. These amendments often reflect changing market conditions, new information about the target company, or disagreements between the parties involved. Then came the second amendment in July of 2023. More adjustments were made along the way. Finally, there was a third amendment in February of 2024, and then they pulled the plug entirely and decided to call it off. Fast forward to December of 2024, the two companies called it quits. They signed a mutual termination agreement, meaning both parties agreed to end the merger plan. As part of this agreement, Infinite Reality was supposed to pay Newbury Street $7 million, a termination fee, by March 1, 2025. Think of it as compensation for all the time and effort Newbury Street put into the deal. Now here's where the drama kicks in. The report states, and I quote, "The company did not receive the termination fee from Infinite Reality by March 1, 2025, as required by the mutual termination agreement." Ouch. That $7 million never showed up. The company said they contacted Infinite Reality about the payment. That's like sending a text asking, "Hey, where's the money?" after you were supposed to get paid. So what does this all mean? Well, for Newbury Street, it's a setback. They spent time and resources pursuing this merger, and now they're not only back at square one, but they're also short $7 million that they were counting on. It raises questions about Infinite Reality's financial situation and their ability to honor their agreements. It also might make investors wary of Newbury Street's deal-making abilities in the future, since this is not a success story. The report was signed by Thomas Bushy, Chief Executive Officer. It's his job to steer the ship through these choppy waters and figure out the next move. Now, let's step back and look at the bigger picture. The SPAC market has been cooling down in recent years. SPACs were very popular a few years ago, but many have struggled to find good targets or complete their mergers. This failed deal and unpaid termination fee highlights some of the risks involved in SPAC transactions. So what's the overall take on Newbury Street? Well, this situation definitely isn't ideal. The failed merger and the missing termination fee are red flags. It shows that Newbury Street needs to be extra careful in choosing its partners and making sure agreements are solid. This deal falling apart reflects poorly on the company's ability to execute deals. However, Newbury Street still has the chance to find another target and deliver value to its shareholders. The company needs to learn from this experience and focus on finding a more reliable partner. They must conduct a thorough due diligence and make sure everyone honors their agreements. Thanks for tuning into Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and subscribe for more deep dives into the world of corporate filings. Until next time.